they don't have that much room to run. We're joined by Bob Iaccino, co-founder and chief market strategist at Path Trading Partners. Bob, are you here to harsh or mellow? I mean, we've seen global equity markets, something like a synchronized run up so far this year. You think the good times could be over for now?
I just think a little too much is priced in. I believe in another 18 to 24 months in the bull market. However, given the circumstances we have now, where we're only about 100 points from the all-time high in the S&P, that's the all-time high. And we don't have a deal on the table yet. We don't have details to look into. And by deal, I mean between the U.S. and China. And when that gets done, which I do believe it will, we still have a deal that needs to be done between the U.S. and Europe, especially with the German automakers. We've got some lower, weaker economic data in China. That'll take a couple of quarters to work out, if it works out at all. Weaker economic data in the EU. That'll take a quarter or two to work out. And then weaker earnings across the U.S. equity space. That'll take a couple quarters to work out, especially the longer it takes to actually get this deal done. We're going to have to actually get the earnings back into the flow, not just the potential for earnings, which is what this is based off of. It's based off of a deal, the Fed backing off, and now we should see a little bit of a respite in terms of the negative earnings projections. Right now, we're looking at Q1 of 2019 estimates of down 3.4% on earnings growth. That's the earnings recession people were calling for.
And then, as you note, I mean, part of your caution here then is that there's really a downside. If they come up with a deal, Mr. Trump and Beijing, the markets may say, oh, we were expecting that. But if they don't, then there's downside.
Excuse me. Yes, that's correct. I think that they'll come up with a deal. I think a deal is going to be signed. But we have priced in a good deal, in my opinion, by getting as high as we have. Because if we're simply pricing it off of forward earnings, currently forward earnings are very depressed. Last earnings season, we had 76 to 78% of the companies, depending on which metric you looked at, which index you looked at. Let's just go with the S&P 500. You had about 74% of the companies that did release forward guidance, release negative guidance, based off of trade tensions and a lack of a trade deal. So if we get a trade deal, does that erase that? Does it erase all of it? Does it erase some of it? Or do we start to get guidance bumped back up? Or do we just get a situation where these companies now jumped over a much lowered bar? I think that last part is what's currently priced in. And if any of that goes wrong, you know, we have a little bit of a history here of signing a very similar deal to what we used to have and calling it a great brand new deal, referencing the USMCA. It could be the same type of situation, and that's great if that's what happens, because that's a trade deal, and at least we can get back to where we were. But is that enough to now heal some of the trade damage that's been done? I'm not sure it is.
Let's have a look at copper, because copper has not been doing badly, and I think some people are surprised. It's not far short of $3 a pound, even though we get these ominous numbers out of China.
Well, that's what I'm looking at, Andrew, and I know you know your commodities just as well as I do. Copper, to me, when it gets close to the old highs, now we're talking. Copper is obviously the canary in the coal mine for a lot of things, but more so the Chinese economy than anything else. So if China actually starts to ramp up their economy, they've already done stimulus. I was with a friend of mine in New York about 10 days ago who used to work at a New York a very large Chinese bank, and he told me that if China is slashing their GDP at the National People's Congress, be concerned that it's probably lower than what they've slashed it to. So given the stimulus measures, given the slashing of the GDP, copper's been doing very well, given all that. If copper starts to approach its new highs, I will change my tune very quickly. And by the way, if we get the sell-off I'm looking for, it's a buying opportunity. I think the U.S. consumer is very strong, so U.S. equities should recover from that dip. But we do need that time to be placed into the markets, copper and otherwise.
What about crude oil? You are fairly bullish on that. You think there's a better chance we see $65 US, and we're almost at 60 now, before we see 50 again.
Yeah, that's why I made it so tight, because I've been saying this for probably about a week now, that we would see 65 before 40. It doesn't really seem fair to say 65 before 40 when we're sitting just below 60. So I'll say 65 before 50, and I say that for any number of reasons, but the main one being is that, again, this is mostly a supply story now. The weaker demand probability is well talked about, and yet you have OPEC being as aggressive as they can be. I feel OPEC recognizes this is their one window over maybe the next 20 years to actually make a dent in crude oil prices, get rid of the current deficit, and see how long they can sustain it. We've got major U.S. oil companies going into shale now. Canada's getting more efficient with their shale production. Mexico's production is up a little bit. OPEC is doing what they can to get a base level of prices for as long as they can, and that may be 5-6 years that they can still control the price, for lack of a better word. But that window's closing for them as these techniques get more and more efficient. So the last production cut, they were 116% compatible to the cut they announced. I think they're going to surpass that. So I think the supply deficit, as Goldman Sachs predicted, is probably gone by next month. We're only 2% above the 5-year average now in the U.S.
So your investment strategy broadly, are you holding a lot of cash?
We are. We're only 30% invested right now, and that's been pretty consistent since January 1. The highest we got this year was 60%. And that really kind of tapered off as we started to get sort of a no news on the trade deal after the Fed kind of pivoted. That's actually when we started taking profits on a lot of things and reassessing, because I feel a stronger case would have been fast trade deal, a comprehensive trade deal, and the Fed saying we're going to wait and see, rather than seeing the CME Fed watch tool now has only one probability of a rate move above 25%. And you have to go all the way out to January 2020, and that's a 29% probability of a rate cut. So that's not necessarily boding well for equities in the longer term. It could turn around pretty quickly. That's market pricing, but that's where it sits right now.
We'll leave it there. Thanks so much for joining us.